Every time the market flashes red and headlines scream about an impending economic collapse, trillions of dollars are wiped out. Retirements are delayed, savings evaporate, and the panic becomes palpable. But while the vast majority of investors are selling at the absolute bottom out of fear, a silent minority is sleeping perfectly fine at night. They aren't relying on incredibly risky day trading strategies, and they certainly aren't betting the farm on the next volatile crypto token. Instead, they have strategically parked their capital in a very specific, unglamorous set of assets. These are the unsung heroes of the financial world. They are assets so profoundly boring, yet so fundamentally necessary to human existence, that they don't just survive the bitter cold of an economic winter, they emerge from it stronger, continuing to pay dividends while the rest of the market burns. Today, we are pulling back the curtain on 5 bulletproof investments that quietly weather every recession. You won't hear about these on finance channels, but they are the bedrock of true, sustainable wealth. Think about what happens when a recession hits. The first thing people do is cut back on discretionary spending. Vacations are canceled, smartphone upgrades are postponed, and eating out becomes a rare luxury. But no matter how bad the economy gets, no matter how high unemployment spikes, people do not stop brushing their teeth. They do not stop buying toilet paper, washing their hair, or feeding their families. This brings us to the very first asset class that acts as a fortress for your portfolio: consumer staples. We are talking about the companies that manufacture the non-negotiable items of daily life. While tech stocks might lose half their value when interest rates rise, the companies selling basic groceries experience a much softer landing. Demand for their products is perfectly inelastic. When you invest in an exchange-traded fund tracking the consumer staples sector, you are essentially investing in human necessity. These companies have pricing power. If raw material costs rise due to inflation, they pass those costs down to the consumer by raising the price of toothpaste. The consumer will grumble, but still buy it. This unwavering cash flow pays steady dividends, providing reliable income exactly when you need it most. Now, let us move from the bathroom cabinet to something even more critical to human survival. If there is one thing more non-negotiable than basic hygiene, it is human health. Illness does not care about the gross domestic product. Disease does not take a break because the Federal Reserve is raising interest rates. This fact makes the healthcare sector our second recession-proof investment. But we are not talking about speculative early-stage biotech companies that burn through cash praying for a miracle drug approval. Those are incredibly volatile. Instead, the focus here is on established pharmaceutical giants, medical device manufacturers, and major health insurance providers. These are massive corporations with deep pipelines of essential medications and medical equipment that hospitals must purchase to function. When the economy takes a downturn, a patient needing insulin will still buy insulin. A hospital needing pacemakers will still buy pacemakers. The global population is aging rapidly, meaning baseline demand for healthcare services is on a permanent upward trajectory regardless of short-term economic hiccups. Investing in diversified healthcare funds provides a defensive shield for your money, bringing strong dividend yields. As we look further into the assets that institutions use to protect their wealth, we find our third hidden gem: utility companies. Water, electricity, and natural gas are the absolute lifelines of the modern world. Think about your own monthly budget. If you lose your job, you will immediately cancel streaming subscriptions and stop buying expensive clothes. But you will do absolutely everything in your power to keep the lights on, the water running, and your home heated. Utility companies operate as regulated monopolies. Because the infrastructure to build a power grid or water system is expensive, the government regulates these companies, guaranteeing them a set rate of return. In exchange for this regulation, utilities have incredibly predictable, highly stable revenues. They know how much cash is going to come through the door next month and next year. This predictability translates directly into large, reliable dividend payouts for shareholders. During a roaring bull market, utility stocks are often ignored because they lack massive growth potential. But when a recession hits and growth stocks crash, those reliable utility dividends look incredibly attractive. Investors rush toward their safety, driving up their value. The fourth investment takes us outside of the stock market and into the realm of tangible assets. For thousands of years across countless empires, wars, and total economic collapses, one asset has universally retained its purchasing power: physical gold. Gold is not a typical equity. It does not produce anything, pay a dividend, or generate a quarterly earnings report. Instead, gold is the ultimate form of financial insurance. It is a store of value that cannot be printed by a central bank or devalued by a reckless government. When inflation runs rampant, tearing away the purchasing power of paper currency. Gold traditionally holds its ground. When a severe recession triggers systemic panic and investors lose faith in the banking system, they instinctively flee to the timeless safety of precious metals. The value of gold is driven by absolute scarcity and the historical consensus that it holds value. Adding a small percentage of gold to a broader portfolio acts as a shock absorber. When everything else is plummeting, gold is often the sole green number on your screen, providing financial protection and psychological comfort during terrifying times. It is the ultimate hedge against systemic fragility. Finally, we arrive at the fifth and perhaps most misunderstood recession-proof investment: United States Treasury bonds. When you buy a Treasury bond, you are lending your money to the government. In return, they promise to pay you back your principal amount plus a fixed rate of interest over a specific period. Because the government can tax citizens and print currency, these bonds are considered the closest thing to a risk-free investment on the planet. During a recession, central banks lower interest rates to stimulate the economy. When interest rates fall, the value of existing bonds with higher interest rates goes up. But more importantly, during severe panic, there is a phenomenon known as the flight to safety. Institutional investors and nervous individuals pull billions out of risky stocks and pour them into the absolute safety of government bonds. This influx of demand drives the price of the bonds up, protecting your capital. If a recession is accompanied by high inflation, specialized instruments like Series I bonds act as a shield for your purchasing power, adjusting directly with inflation rates. The harsh reality is that recessions are inevitable. They are a natural, unavoidable part of the economic cycle. But just as you wouldn't walk out into a blizzard wearing only a t-shirt, you shouldn't let your portfolio freeze when the economic climate turns cold. By strategically shifting a portion of your wealth into these 5 quiet survivors, you transform your portfolio from a fragile house of cards into an absolute fortress. You stop relying on the hope of a perpetual bull market and instead build a foundation that thrives on the boring, the essential, and the guaranteed. It is not about getting incredibly rich overnight. It is about ensuring that you never have to start over from zero. So the next time the headlines scream that the sky is falling, you can simply turn off the television, knowing that your investments are quietly, diligently working for you, exactly as they were designed to do. Would you like me to suggest specific ticker symbols or funds for any of these 5 asset classes to help you start your research?